What if you could invest in a hard asset like silver and then earn a return in that same asset, bypassing the fiat dollar system entirely? Now you can. Monetary Metals has made a name for itself by generating a yield on gold and silver for their clients over the past 8 years and counting. Now they're offering the first silver bond in almost 200 years with a 12% annual interest rate paid in physical ounces of silver. Available to accredited investors only, investors in the bond receive a fixed 12% coupon on silver paid in physical ounces of silver, plus any silver price appreciation. Over half the bond has already been sold, and the remaining allocations are going fast. Do not miss being a part of this historic offering. Protect and grow your wealth in an asset that has stood the test of time. Secure your spot at realvision.com/metals.
Hi, it's Raoul. Guess what? I can't believe, but we're turning 10 at Real Vision this September. I can't believe it's a whole decade of democratizing the very best financial intelligence and building this kind of super community of finance, including the super platform of finance. And to celebrate, we're throwing a virtual party on September 27th at 12 p.m. and you are on the guest list. It's free to join, so don't miss out. If you're not a member, you can sign up at realvision.com/free. We've also got a trade ideas competition where you can flex your market smarts, plus some exclusive limited birthday merch and much more planned for September. It's going to be a lot of fun. So sign up, realvision.com/free, and we'll see you at the party, September 27th at 12 p.m. That's realvision.com/free.
Welcome back to Real Vision. I'm Ash Bennington. Today, we have a special treat for you. We're joined by not one, but two industry-leading chief investment officers. Sebastian Page, head of global multi-asset and chief investment officer at T. Rowe Price, and Omar Aguilar, chief executive officer and chief investment officer at Schwab Asset Management. Our guests are here to discuss some of the most pressing topics in today's macroeconomic landscape. Gentlemen, thank you for joining us.
Thank you, Ash.
Thank you. Happy to be here.
Guys, lots happening right now. Let's start out for our viewers with the 50,000-foot overview, the big picture of what you guys see going on in the macro landscape today. I'm going to go left to right. Sebastian, first to you.
Ash, I don't expect a recession in the next 12 months. The probability is never zero, but that's not my base case. In our asset allocation committee, Ash, we're having the mother of all debates between the bulls and the bears. Our portfolios are very close to neutral between stocks and bonds. What are the bulls saying? What are the top arguments for the bulls? And what are the top arguments for the bears? If I tried to make it really simple, I would say that the bulls are saying, look, let's be very pragmatic. Rates are coming down and earnings are coming up. That's generally good for risk assets, for stocks. What are the bears saying? Well, their top arguments are pretty compelling too. The economy is slowing. If you look at manufacturing PMIs or economic surprise indices, for example, and valuations are really high. We're close to all-time high on stocks. The price-earnings ratio is 21. So a slowing economy with high valuations, it gives the bears pretty good ammunition. So here we are. And when I say, Ash, neutral between stocks and bonds, it's all about being fully invested at a risk level that matches your long-term risk tolerance. So a lot of people like the 60-40 portfolio, but if you're early in your career, you might have 80% stocks for the long run. Well, if that's your position, just stay at 80-20. If you're a 60-40, stay at 60-40. Just be close to how you're prepared to take risk in general in markets. Now is not the time to be a hero. There are opportunities for tactical asset allocation, and I hope we'll talk about them. But if you look at what the bears are saying, what the bulls are saying, it's a pretty good debate. and it speaks to staying neutral as we get into the election. I'll say one more thing, Ash, on how we're thinking about markets. We often say markets are expensive these days, and that's a good argument for the bears. But I think Omar's talked about this as well. It's very bifurcated. You're looking at an average valuation of 21 price earnings ratio, but I'm reminded of the analogy that I like to use of the statistician who apparently had their head in the freezer and their feet in the oven. And Ash, they claimed that on average, they felt awesome, that their body temperature was perfect on average. Growth stocks have a price earnings ratio of 30, which is 10 points above their long run average. While value stocks have price earnings ratio of around 15, which is actually right on their long run average. So, and then you look at small caps and emerging markets, you have this bifurcated, concentrated market where some stocks look expensive while others don't, and the average doesn't tell you much.
Sebastian, very well said, very crisply framed. Omar, over to you. Sebastian touched on some of the key issues that we've been talking about here on Real Vision. Big picture, what's your view of what's happening right now?
Yes, and by the way, I'm a statistician, so I actually have never put my head in the freezer to begin with, but I actually can understand, how could that feel? A few things, starting just with the macro world and what we have observed, and the way that we will look at the bigger economical picture is that we have shifted from what it used to be the discussion about inflation. If you recall, not too long ago, all of us were just talking about how high the inflation was, how this was historical for all terms, not just in the United States, but globally, how, the big spikes and the inventory, issues that we had, supply chain disruptions because of the pandemic ended up, putting a significant amount of pressure across the globe on inflation. Obviously central banks, starting with the Federal Reserve, talk about the transitory version of that inflation. And therefore, their monetary policy is starting to just become incredibly tight to try to fight that. So when you think about that it was not too long ago, we were just talking about that even, a year or a year and a half ago from this, going now into the opposite side where we see the effects of disinflation affecting the global economy. So it is a natural, component to think that if inflation is no longer the discussion across central banks and across investors and across, clients, and corporations, obviously the focus now becomes on what is the state, on what is the health of the economy. So the bigger question right now is that if we think about the decisions that central banks have to make is that, well, if we think that inflation is no longer the issue, what will basically make us, go faster in reducing rates for monetary policy and therefore sustain an economy that can grow at a good pace? And the answer to that is labor market. So a lot of the discussion goes from now, going from inflation to now, is the labor market something that will potentially put economies in recession? And the answer to us continues to be, the answer is no. We see that softening in labor market is being more supply driven, which means, people are not getting fired. What happens is that there is a significant amount of extra workers that are looking for jobs, but there are not that many openings. And what that means is that, well, usually if the economy is in a bad shape or if we're getting close to recession, I think Sebastian said this earlier, if those probabilities of getting into a recession were very, very high, and therefore we see that we're naturally going to go there, well, number one, we will see significantly more pressure in the labor market. And also we will see a reduction in productivity because basically corporations are just reducing costs at all costs. Now, what that does is that it would put the pressure on central banks to be faster in reducing rates. So that the question that we have seen, obviously, and we have received from our clients is that, we're starting the new cycle for the Fed, and then the ECB just cut rates this morning to second time, which means that, every single central bank is in the process of going to the easing cycle. And when you actually go to that, is it going to be faster or is it going to be slow? And the answer to that is really, the health of the economy. Since we're not in recession territory, since we're not even close to just getting to a recession, then central central banks have a lot of flexibility to be able to reduce rates and therefore being able to sustain some level of control over inflation while at the same time don't disrupt the economy too much. So, it is an interesting piece where we're going from what it was a hot economy, slowing down the economy, going now to what we think is going to be a soft landing. But as Sebastian said, and we have established and published, is that it is all bifurcated because it's very confusing. On one hand, you see, PMIs being under pressure, labor market being under pressure, housing being under pressure. And on the other hand, and then the economists and statisticians have three hands, the other hand usually, talks about, well, earnings and corporations are good, balance sheets are still pretty good, the credit market is still pretty good, consumers still doing pretty good. And overall, you see that, bifurcation that Sebastian was talking about and that we have discussed, where there's enough emphasis on the potential headwinds for the economy that are countered by the tailwinds that also the economy will have. For us, what that means is we're all going back to the normal. And what that means is this finally, and this is just the first quarter we see this, a lot of the numbers and a lot of the things that started to make more sense, more than what we had after the COVID, recession that we had several years back. We're finally see that normalization of many things, normalization of the labor market, normalization of the housing market, normalization of the areas that produce inflation, like wage growth, or areas that produce, challenges like supply in the rental market. So we see a lot of that normalization that will transpire into what monetary policy be, that also will go to a more normal, cycle.
Guys, so much to talk about. Very well said, Omar. Let's talk a little bit about this idea of normalization, where we are right now. I mean, one of the interesting things about this particular moment, I know I've said this word a lot here, which is this idea of unprecedented. Obviously, when you look at the charts, be it CPI, when you look at the U6 numbers, the U3 numbers, when you go back decades, we've just not seen anything like this. We've had this bizarre kind of inflation snapback. Obviously, we got up to about 9% on CPI 2 summers ago. Now we just got the latest August number trending at about 2.5% on an annualized basis, trailing 12 months. Just an extraordinary snapback scenario. Is this true normalization? Do we have hysteresis effects? Do we have effects in these markets, be they the labor markets, challenges with inflation that may be durable, that may be just a little bit wobblier than we're used to typically seeing, just because of the head snap that we've seen in all of these markets as a consequence of, on the one hand, the COVID shutdown, and on the other hand, the reopening?
Ash, I would say there's a lot of whiplash from a lot of investors and a lot of economists. A couple of months ago, I had to tell my team, stop looking at year-over-year charts. Now, this sounds trite, but if you have a massive shock up in inflation or in house prices or in job creation or in liquidity, and you're used to looking at year-over-year changes, now pretty soon as you normalize, those numbers are cratering because you're on the other side of the roller coaster, and that's flashing a bunch of red signals in your macro dashboard. And it's so simple, but I think that's why a lot of economists got the last recession calls in 2023 wrong. Everyone's calling for a recession. The probabilities were in the 60% of recession, according to the Bloomberg consensus. So I asked my team, okay, you can look at year-over-year charts, but show me the level as well. And so interpreting data in a normalization process with this whiplash involves thinking about levels as well as year-over-year changes. Take unemployment. It's at 4.2. That's actually not too bad. And it's not the average of, just look at the average of the last 6-7 recessions. It was in the 5s. And it's the same with job creation, right? There was a lot of market volatility after we got a non-farm payroll of 114,000. That's, go back to the history. The average is something like 130. That's not, but from a level perspective, it's not that bad a number. So it sounds trite, but I think this whiplash is what's confused a lot of economists. And I'm not here, like, I don't want to just pick on economists. They have a really tough job, and I read a lot of economic research. I don't want to pick on anybody. And statisticians, What we do in investment management is hard, Ash. But just look at the end of last year. We had 3 months in a row where if you took the 3 CPI prints at the end of last year and you annualized it, we were running at 2% inflation. That was at Q4 of 2023. And then what happened in Q1 of 2024? For the 3 months annualized, all of a sudden we were running at 4.5%. And then we went back down. So this is the whiplash. The base case is that inflation is coming down. Omar talked about it. He talked about the big, massive transition from inflation risk to growth risk and focusing on unemployment. And central banks are really eager to lower rates. But I'm not ready to say that inflation risk has gone away. I'm not talking about going back to 6, 7, 8%, but I think you could have a commodity shock. The inflation outcome could be inflationary under certain scenarios. Housing is not that predictable. It's not that sensitive to rates anymore. You could have all sorts of things that would take you back to 3, 4, 5% pretty easily over a 3, 4, 5 month period. What then? So I don't think the risk is gone. And I don't think Omar thinks the risk is gone either. He's just describing the base case. But so in our portfolios, we do have some hedges for inflation risk in this environment, even though the base case that inflation's coming down.
And Ash, what I would probably add to all this is I guess let's just remember a little bit of how we got to this point and how these, as you mentioned, unprecedented statistics, ended up showing up in all our screens. And I agree 100% on just not necessarily get fooled by the denominator and the basis of how you calculate things on percentages, because that will distort anybody's screens and it will look weird. But if you think about just how we got to this place, it was because the unprecedented, going back to the word that you mentioned, of what we had during the pandemic. The pandemic basically created an unprecedented distortion of lives, an unprecedented distortion of balance sheets of corporations and consumers, because for year or year and a half, or in some cases longer, people didn't use. They had a lot of that. They basically ended up accumulating cash and creating just very strong balance sheets. And then, when you created that structure and created the supply, issues that we discussed, all of a sudden all got together to create that, very real inflation pressure that translated into further escalation because of wage growth. So in other words, if prices of goods and prices of services started to go up, employers and employees will demand for higher wages, and that therefore created more pressure from now, another source, which is now wages are going faster. So when you combine those effects, the inflation was real, and the inflation was something that was completely underestimated by the majority of people, including central banks. And therefore, we got to those levels where it became so real and so clear that needed to happen and needed to change. Now, what I believe is being the case, and I think that's what gives central banks and all of us as in the investment area a little bit of more of a calm situation, is to say, like, we know the trend on inflation has actually gone down. And we will see these flips and this volatility in the numbers on CPIs, PPIs, continue to just go up and down, because, as Sebastian said, it is not very clear that all that is gone. There will be other reasons why these things may change, but we can see the trend is going into the right direction. And we can see that not only that, but central banks, because of the way that they raise rates during the periods of high inflation, they have a significant amount of flexibility to be able to work with that. In other words, the Fed today is at 525, 550, and they have a significant amount of room to be able to reduce rates to stimulate the economy if they see a growth issue, or they can stay if they think that inflation is coming back. In other words, they have created the right setup to be able to prevent for something else that may change, the way they are. Now, again, in our view, there is one component, and I'll say the last, that has also not necessarily been well described, which is the effect of China. China for the longest time, especially in the years after pandemic, became a source of inflation. Basically, they were exporting inflation because a lot of their manufacturing goods were more expensive. Now, we are now in the opposite side because of the way that the Chinese economy has evolved over the last few years, particularly their challenges in terms of demographics, as well as of some of the real estate issues. Now they're at the point where the economy has slowed down so significant that now they're basically importing this inflation to the rest of the world. So a lot of what we see in terms of goods and services, commodities and others, lower prices that have actually put a lot of the CPI, PPI numbers and others being lower in terms of inflation, have also been directly or indirectly linked to the way that the Chinese, economy has evolved. So when you put that in perspective, we see that in inflation side, the goods continue to go down to a trend that everybody seems to be very comfortable with. The services side, which is more of a local, source of inflation, is still sort of the rest that we think we could potentially have. But with the labor market being our barometer, we can probably see that that's manageable going forward.
Omar, important points there about China. I want to pick up on your prior point about where we are right now with the Fed, this expectation of a rate cut. By the way, I should say, for our viewers and listeners who don't follow these markets as closely as you two guys do, the important point is, if the last 10 minutes, what we've been talking about here, you hear words like hysteresis, unprecedented. We talk about base effects, all of these things. The bottom line is that this type of economic cycle prediction is challenging enough under ordinary circumstances. If we were having this conversation, in 2019 with our two great guests, these are challenging questions then. Now you add on this additional layer of complexity from the closing down of the economy, the reopening of the economy, base effects, all of these challenges. This is a complicated time for everyone, and it's great to have both of you here as we unpack these issues. So let's talk about what's on everyone's mind right now, which is what's happening with the Fed. You mentioned, Omar, ECB cutting. They are ahead of the Fed in this in terms of global liquidity. Let's talk about the expectations for where the Fed is going to move next week. Guys, Sebastian, over to you first. Big picture analysis on what's happening at the Fed.
So the most likely case for next week is probably 25 basis points, but there's a little bit of a debate between 25 and 50. The core inflation that we just had was a little bit higher than consensus, and that might push the Fed to just do 25. But if you step back and you look at what's priced in terms of number of cuts by the end of 25, that number is 10 cuts. That is a pretty rapid and aggressive cutting cycle. One of our analysts sent me this yesterday, where he looked at what's expected in terms of cuts as a proportion of the current level of rates. And he ranked all the cutting cycles in history. And this would be the second, by that measure, most aggressive cutting cycle in history. And it's kind of odd if you step back, right? Because Omar and I aren't talking about huge recession risk, which is usually when the Fed cuts. So what's going on? Well, the real rate is pretty high, because if inflation really is coming down to, say, 2.5, and the Fed funds are at 5.5, the difference, that real rate, is pretty high. I also have a theory that about half the people I ask agree with me strongly, and the other half disagree with me strongly. So let's see where you fit, Ash, on that, and Omar. But the level of government debt is so high that I think it is making the Fed on the margin eager to cut rates, because debt service is exploding. Talk about unprecedented levels of debt service. The cost, it's going to be like the number 2 biggest expense for the government. So I think that creates an environment where the Fed wants to cut. Now, if you ask an economist on the 50% that disagree with me, they'll tell me, again, I'm not picking on economists today. Maybe I am. They'll tell me, look, the Fed is not supposed to do that. It's not supposed to look at the fiscal situation at all, right? And then if you talk to others who kind of just look at it on the surface without much of an economic lens, they'll say, well, yeah, you got to bring the cost of borrowing for the government down because that deficit is just exploding. So, Ash, Omar, tell me where you stand. I did a survey on LinkedIn of all my followers who are mainly finance people, and it was about 50-50. And the question was, is the Fed eager to cut because debt service is exploding for the government? And it was 50-50 kind of answer. So I'm curious where you all stand.
You want to unfuck your shit?
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Well, it's interesting. They're not supposed to consider debt service. They're also not supposed to consider U.S. equity market levels as well. So I guess you could take that all with a grain of salt. But to your point, and it's such an important one, you talk about the exploding cost of servicing the debt and the crowding out effects on the fiscal side as a consequence of that. I would also mention exploding public debt to GDP levels. If you look at that chart going back 50 years, certainly cause for concern. Omar, I'm curious about your thoughts and the question Sebastian posed. Big picture, where do you fall on this?
Omar, notice that he dodged a question.
Well, I would probably say, I don't know if I'm considered economist, strategist, or a statistician, but regardless, our point of view, at least on the Fed, it is, and related to the specific question is that, the level of debt is always been a concern and a discussion in central banks. And this is going back even to the Greenspan days, and the discussion around it is probably less relevant to the current cycle of what their decisions are. And they will probably not make monetary policy based off that. With that in mind, the government and the Treasury Department seem to be more preoccupied for that, what that could mean going forward. But our approach, or at least our thinking right now, is that the Fed decisions may not necessarily be influenced by what may happen with the level of the deficit, or what may be even with what would be the next tax policies that we may have after the election. So we believe that, at least for now, the Fed has two clear mandates that they continue to follow, and they have one that is unwritten, which is, on one hand, they're looking at inflation. The second mandate is looking at the labor market, and the unspoken mandate is financial stability. That I think, Ash, to your point, we believe that, Chair Jerome Powell has a big, a terminal in his, house and in his office. Would you see the equity and the fixed income markets and see how they behave every day, even currencies? They want to see what the dollar is. And I think that's probably something they look at a lot. And I would probably say, which is the original question.
Hey, Omar,
give me 1 second. Give me 1 second. So the original question related to whether or not it's 25 basis points or 50 basis points, had to do in many cases with what is the message they wanna have. I think based on the pure structure of what the Fed, has done and how they operate and how the committee works, the many things that they are looking at is that in their mind and in our mind as well, they have the room to do 50 and do several 50 basis points without having a significant effect on the economy. Because I think Sebastian said this earlier, we're not in recession territory. Usually the Fed cuts rates most aggressively when they see a significant challenge in the economy. Now, we believe firmly that they're not going to do 50 this time because they see inflation trend is going into the right place. They see the sources of the labor market being under control and in certain way, just as Sebastian said, back to the normal, back to the averages. So they see that their two mandates seem to be in controllable territory. So if they do 50, the message they will send to the market is that something is wrong and that the economy may be in trouble, and therefore the market will probably have that lack of stability that they're looking for. So, Sebastian, sorry that I was just going through my train of thought without losing it.
No worries. I think you're right. I think the base case is 25.
Hey, let me ask you this while we're talking about the fiscal side. I had this conversation with Komal Sri Kumar a couple of days ago. Where have the deficit hawks gone? Is that even a term that exists anymore? Where are the folks out there? Where are the bond vigilantes? Where are the Pete Petersons of the world who are saying, hey, guys, Are we looking at this? Are we looking at debt service costs? Are we looking at debt to GDP ratios? I mean, the bond vigilantes are just not showing up when you look at the 10-year yield, when you look at the 2-year yield. Where is that view in these markets right now?
Ash,
Well, go ahead,
go ahead.
Sebastian. No, go ahead, Sebastian.
There's a popular analogy when people talk about the deficit. It's the one with the boiling frog. And it's a story that if you put a frog in water and you crank the temperature little by little, the frog won't realize until it dies, it boils. It turns out, by the way, I looked into it because I was writing a paper on it. It's scientifically untrue. It's been disproven. The frog will jump out. But this analogy is used a lot in business for companies getting complacent, but also this idea that the deficit just keeps increasing. Nothing happens. The bond vigilantes don't step in. And then at some point, the frog boils. And you've had some of that in the UK. People not call it the Liz Truss moment. I've looked into it. I think we're kind of fine if you take a 12-month horizon, but it is a big long-term problem. If you're losing sleep about the deficit, which I agree with you, Ash, neither party is even sort of talking about really attacking the deficit. I mean, they are, but in a talking point sense, as opposed to real policy proposals. So are we going to be the boiling frog? And if it's keeping you from sleeping at night, maybe I play devil's advocate and give you the other side, right? There's a tremendous demand for US government debt. And if as investors, there are many safe assets in the world. And as long as that remains, that there's just huge demand to hold treasuries, then the bond vigilantes can stay at bay. And that's why I think we're kind of fine for now. A lot of people hit the panic button on the deficit over time, and it never seems to sort of happen. Again, it's a long-term problem. One more thing I'll say, Ash, about this is actually controversial in academic research, because there's a famous study by Reinhardt and Rogoff that says that if your debt to GDP is above, I think it was 90% level, your subsequent growth, and they looked across country over time, is actually negative. So high debt burdens are bad for growth. This is a famous study because these are really credible academics. And it turns out, you can look it up, they had an Excel error in their study. And they forgot, when they did the average across the countries in the growth, they forgot the first 3 countries. Like, I think it was like Australia, Belgium, Canada, like alphabetical. And then when other academics replicated the study, they actually realized that high debt burdens historically weren't always that bad for subsequent growth, and that the average was more like 2%, which is kind of like almost like normal growth. So you'd have to go way higher. And so the economic theory, the academic debate around how bad is high debt levels for growth, we've had high debt levels and we've had pretty good growth, is, I will say, unresolved. I mean, at some point, something breaks, right? But it's not a given.
Yeah, and we have all these sort of weird complexifiers. We obviously experienced significant increases in debt to GDP levels around the time of the dramatic unconventional monetary policy coming out of the global financial crisis, going from about 60% levels to about 120% debt levels in debt to GDP levels here in the United States. But the additional complexifier on this is the demand for U.S. paper across the world. So it is sort of just an interesting open question, guys. I want to shift gears here just a little bit to talk about the reason that I know a lot of folks are tuning in right now, to talk about tactical portfolio allocation in this environment and how you guys think about it. We've just set the table. We've made the case. We've talked about what's happening from a global macro perspective, from a risk asset allocation perspective. How are you guys thinking about this right now? Omar, first to you.
Well, several things. First of all, we're starting, I think, a more normal cycle, and I think what we believe is the case now is we look at our asset allocation. This is probably one of the best periods of time where we can see asset classes expected returns and expected, valuations to actually be the most competitive that we have seen in 15 years. If you actually think about the last 15 years, the majority of risk capital has been allocated to risky assets because, interest rates were so depressed that, there was nothing to make in total return. Even this year, still you have equity markets returning between 15 and 18%, and the total return on bonds is being in the single digits. So, even in that period of time, where we have high rates, we see that sort of discrepancy. And what we see so far is that what is called the equity risk premium, has, slowly, coming down. In other words, we continue to see compression on that equity risk premium. But, what that means is that we got to look at the relative attractiveness of different asset classes. So what we believe at this moment is that, first starting with just the allocations between equities, bonds, and cash, is that there is an allocation to the three asset classes, but we are not necessarily thrilled about taking excessive risk in any of these asset classes. At the point that, in this particular case, if you look at equities, we don't necessarily think that they have, a significant amount of downside risk. I think even though certain parts of the market continue to just be, at the higher levels of their historical valuations, even at the multiples that we are today, we see the capital expenditure cycle being very supportive of what could be earnings growth. I think we're just talking about debt to GDP ratio. When you look at earnings to GDP ratio, we still see the equity markets discounting at 7% to 9% growth in earnings above the economy growth in the US, which is still I would say is not crazy, but if you compare that to say 2000, that was only 4%. So just to put it in perspective, right at the beginning when the internet was sort of a big boom, we saw that equity earnings growth to GDP to be at 4%. Now that translates today with the whole component and the entire capex devoted to AI now going to 7 to 9%. So when you compare those two, while we see that that's a potential opportunity, at the same time we also see that they may be sustaining that level of earnings growth is something that the market will need to test over the next few years. So equities look attractive, not crazy attractive, the valuations are high. And then relative to fixed income, clearly, there's an opportunity to generate income within the asset classes. And there's yields that, we don't have, but we don't think they're going to go down as bad as they were just, even 10 years ago. Now, what we continue to encourage our clients, especially in their bond portfolios, and I know you have a lot of audience that look at their fixed income portfolios, is that they have been holding, short-term paper for a long time. And this has been the right call. They've been right by earning in cash, between 5 and 5.25 if you go to a money market fund, and that has been great. Now, at this point, with the idea of the Fed reducing rates and going to an easing cycle, we continue to encourage our clients to just start extending their duration and look beyond treasuries. High quality, bonds, extending duration to intermediates. It's always like a good way to deploy some of that cash while they stay within their fixed income allocation. There is no need to go crazy in credit. In other words, there don't need to go all the way to the high yield because again, the corporate market is still pretty solid. There's no reason for be chasing yield that much because you still can get pretty attractive, yields, even if you don't have to go all the way to high yield credit. So, in summary, we basically think that we can be neutral between equities and bonds at the moment. And within fixed income and cash, we want to, clients to look at more high quality intermediate bonds in the corporate world to extend duration.
Okay, neutral between equities and bonds and extending duration. Sebastian, over to you. Thoughts?
It will sound similar. I'll put an exclamation point on what Omar just said about taking some of that cash and extending the duration, starting to move some money from cash to bonds. We studied 12 Fed cutting cycles over 70 years. 12 out of 12 times during those cutting cycles, bonds outperformed cash by a remarkable average of 8%. So even if the yield curve was inverted into the cutting cycle, like it is right now, which happened 5 times out of 12, bonds still outperform cash. So if you get even if the yield curve steepens, but overall rates come down, you have more duration, you have more of a response to lower rates in your bond portfolio. So we've actually been underweight bonds, long cash and long credits, or underweight duration, but we're starting to look at deploying some of that cash. So we're listening to what Omar is saying. I also think there's an opportunity to position your stock portfolio for finally a market broadening. You're seeing it. Value stocks are outperforming growth stocks since growth stocks peaked by about 10% already. When you had markets that were that concentrated, when the tech bubble burst, value stocks outperformed growth stocks by 45% within 12 months. And you saw some of this in 2022, where value stocks outperformed growth stocks by 20% within a year. So when you have such concentration and the valuations are so stretched, you get an opportunity to diversify your portfolio across value and growth by rebalancing, taking some profit out of those really nice returns you've gotten growth stocks. And by the end of this year, Ash, the year-over-year earnings growth for value stocks is expected to outpace the year-over-year earnings growth for growth stocks, believe it or not. And that is because the comparables are so high for growth stocks and so attractive for value stocks. So you have a fundamental tailwind that should materialize that just doesn't seem to be priced in right now. Going back to my head in the freezer, feet in the oven. The valuation of the market on average is 21, but it's really an extreme of fairly highly valued growth stocks and average valuations for value stocks. So there's an opportunity to do that, to overweight value stocks.
Yeah, it's just like saying the weather in New York City is always 55 degrees, plus or minus 40 temperature points. And this is the challenge. And as we talk about this snapback for value stocks, I mean, they've been so unloved for so long.
Yeah. And by the way, 55 degree, Omar and I are both runners. It's the optimal weather for running.
It's true. It's true. And I would probably say, if you want no volatility in weather, come to California. The volatility, I think the weather, a lot of the predictors of weather actually don't have a good, they have an easy job here.
But to rub it in, Omar.
Well, right now it's probably okay because the fall on the East Coast is beautiful. So and especially for runners is like the best time to run. And Ash, I just wanted just add on to what the discussion is in here, because I think to answer your question, I think the biggest challenge that we have faced as an industry is that we have followed into the wrong definition of value and growth. We tend to follow indices and the description of index providers for what should be called value and what should be called growth. I think we sort of need to just redefine, what we mean by value or what we mean by growth. Because when you look at the traditional, and I'm going to call it cyclical sectors, there's a lot of cyclical sectors that generate significant amount of growth in their free cash flow that are so attractive that if you erase what sector they belong, they erase the name of the industry, you erase everything, they look like a growth stock. And then the same thing, if you even go within the growth index and take, random sample of those growth stocks, and then just look at it and erase their name. It looks at, what is their price to book? What is their earnings growth? What is their fees? They don't look like growth at all. It's just that it turns out that, the definition of those indices basically sway us to go one way or another. So, I sort of always try to think, especially in this point in the economic cycle, that, we got to think about, those sectors and those industries and those stocks that have the most sensitivity to interest rate changes. And I think if you put that there, and we did this study that basically show, all right, if you look at relative valuation, again, forget about this. Let's just think about what is the most attractive valuation-wise today, which is for the most part will be the most conservative or the most stable sector. So you will have utilities, you will have consumer staples, you will have healthcare. They will actually look incredibly, incredibly attractive relative to the rest, as for what we described before, this concentration that we had in these mega cap, tech names. Well, when you look at those, they are not going to benefit from lower interest rates. They are not at all. Like, they historically, if you look at their, sensitivity to changes in interest rates is very little. Now, they do change in those periods where there is a recession. In other words, if the rates coming down because there's a recession, concerns, or there's a risk of recession, or there's already in recession, then they tend to benefit. The majority of all the other cases, they don't. Now, when you look at what are those areas in the equity market that benefit from lower interest rates, usually tend to be smaller caps, usually tend to be, technology and others, they're more highly priced. Why? Because the discount rate is going to come down. And that in itself, reset valuations right away. So again, go back to your earlier point about value and growth. Guess what? These things are going to change once you change the denominator on how you value these stocks with the discount rate being different. So a year from now, if you put everything constant, because interest rates are going to be cut down at least by 100, 200 basis points, the discount rates and the valuation will look very different. So it's just one of those things that, we encourage your audience to just not necessarily just get wedded to what, an index provider decide that it's a value or what is a growth. Just look at what is the economic footprint of each one of these stocks and sectors and make decisions accordingly.
Omar, that's the $50 trillion question here. Is which stocks are going to benefit most from a rate cut, from an easing posture? Sebastian, over to you. Thoughts on that question?
Well, Omar makes a really good point about the duration of different stocks. Now, estimating the sensitivity to interest rates of different stocks is very difficult. Typically, you would say, well, growth stocks have cash flows further out into the future, so they're more sensitive to interest rates. So if rates go down, they should do better. Value stocks have a lot of financials, which historically actually have had negative duration. So they do better when rates go up because they borrow shorter, especially if the yield curve steepens. But it's not that simple. And we've seen that relationship completely break down with AI. And it's just distorting the duration of different stocks. And Omar makes really good points about those definitions. Intangibles are not accounted in the right way for growth stocks. And that makes growth stocks look more expensive than they should. Hey, I just said something positive about growth stocks. By the way, I'm at T. Rowe Price. We love growth stocks. We love a lot of these companies. We're just very selective. What I'm talking about going to value is a tactical asset allocation shift from our asset allocation committee. Doesn't mean we don't like growth stocks. So I have a paper coming out in the Journal of Portfolio Management, and the title is When Valuation Fails. And it's about what Omar is describing, the problem of classifying value stocks. And I have this chart in the paper where value stocks have just constantly underperform growth stocks, and you've never sort of for 10 years had any sort of meaningful reversion. So we go into it and we say the problem is technology and how intangibles are measured in those accounting ratios, which then go into the index providers' algos. So I could not agree more with Omar, and I'm giving you a little bit of a dodge about which stocks will do best as rates come down, because, it's a tough question. But if you just want to go statistically, you go and look at the stocks and say which ones are just more sensitive, which ones have the highest duration. Like real estate, for example, will in most markets have a higher duration, or growth stocks, but it's not that simple.
That sounds like some great light beach reading, Sebastian. I think we could carry on this conversation for probably another 3 hours. It's a fantastic one, but I want to be mindful of time here, and I want to give you guys each an opportunity to give final thoughts and key takeaways from this wide-ranging conversation. Omar, first, over to you. Final thoughts, key takeaways that you'd like to leave our viewers and our listeners with.
Yeah, well, we always like to close any discussions we had about markets, economy, and everything else with just our philosophical view on stay disciplined, stay invested, stay diversified. those are sort of the critical components of what, investors and clients, we always encourage. Our teams have the same thing. Stay disciplined means, you have to follow your process, across the board. No matter what, having a structural process that you follow when you take into consideration your investment objectives, when you take consideration the risk you're willing to take, when you think about what you need to do. We know there is inflation, we know there is interest rate changes, we know there is valuation, there's no volatility, we have elections coming up, there is significant amount of risk there. Follow your process, stay disciplined, don't get, confused, and just continue to follow the structure that you have. Stay invested. I think, Sebastian said this, I think at the beginning of this conversation, being fully invested has always been good. And one thing that I would always say, not being invested, it's already a decision. In other words, the opportunity cost for not investing your money, it's already a decision. So even though many people say, well, no, I don't want to make decisions, I'm confused, I'm really scared, I don't want to do this. Well, staying without investing is already a decision. So stay invested. The time in the market, and let me just say this because we tend to say this all the time. Time in the market is more important than timing the market. In other words, people tend to just figure out when they're going to in and out and get in and out. Well, staying invested is always more important than trying to figure out when you're going to be in or when you're going to be out. And then finally, stay diversified. I mean, we didn't have a chance to talk about international markets. We didn't talk about, other parts of the market, even within, fixed income. But overall, this is because, and I think Sebastian and I agree on this, that right now there's no real clear opportunities that things that are going to be incredibly good for the next 12 months. Well, if that is the case, this is the perfect opportunity to continue to diversify your portfolio because you don't know which one is going to win. So that's about it.
Omar, those are just important sort of old verities that people need, obviously, to think about here. All of the statistical data represents that being true, this idea of time in the market versus timing the market and diversification, a huge amount of scholarly literature to support those points. Sebastian, over to you. Final thoughts, key takeaways for our viewers and our listeners.
I wish I'd gone first because I was actually going to say the same thing. And, if you're in the investment business, Ash, Omar, I'm sure you get this. People ask you just for advice, right? Oh, you're in investment. My dentist, for example, will ask me for advice. I'm in the chair. Do you have investment advice for me? And he's between drillings. And I always say, stay invested, stay diversified. I mean, it's trite, but in this market environment where we're on a knife's edge between barbelled economic data and signals, an election coming up, time in the market is important, stay invested, but it's not the time to be a hero. And it will help you. And now I'm going to end with T. Rowe Price's tagline: to be invested and diversified will help you invest with confidence.
I think these truths cannot be repeated enough. A fantastic conversation. Watch this one twice. So much knowledge here. Guys, thank you so much for joining us.
What if you could invest in a hard asset like silver and then earn a return in that same asset, bypassing the fiat dollar system entirely? Now you can. Monetary Metals has made a name for itself by generating a yield on gold and silver for their clients over the past 8 years and counting. Now they're offering the first silver bond in almost 200 years with a 12% annual interest rate paid in physical ounces of silver. Available to accredited investors only, investors in the bond receive a fixed 12% coupon on silver paid in physical ounces of silver, plus any silver price appreciation. Over half the bond has already been sold, and the remaining allocations are going fast. Do not miss being a part of this historic offering. Protect and grow your wealth in an asset that has stood the test of time. Secure your spot at realvision.com/metals.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.